So we also promise that today's training will be very enlightening on what are we actually having training on today. It is income tax, transfer pricing, regulations in Nigeria. Um, we have identified that not everyone is actually abreast of relevant information about transfer pricing as we practice it in Nigeria within the tax space. So today, what we'll be talking about today may not entirely cover all the relevant facts that you need to know about transfer pricing. But we will try as much as possible to give you the fundamental insight you need to have about transfer pricing, because within the time limit of these 2 hours training, we can't cover all the scope of transfer pricing, but we'll try as much as possible to give you the basic tips you need such that when discussions around transfer pricing is being put up, you can contribute meaningfully and also understand the scope of the discourse. So please listen very well, and at the end of the section, there will be room for you to ask questions. All right. So it's also an other opportunity and privilege to pilot you through this training on income tax transfer pricing regulations in Nigeria, what you need to know. All protocol duly observed. My name is Adekunle Cole. I'm opportune to be the managing consultant of KCP. KCP is a professional accounting firm with expertise in accounting support services, audit services, tax services, training as you are benefiting from, and other assurance services. Our existing listener will have been acquitted with some of these disclaimers that the essence of this training does not constitute any advice to anybody. Rather, it is information for general knowledge purpose. We are not saying that what we are discussing here are not what you can rely on. Of course, they are what you can rely on, but what we mean is that application of general information of this nature should not be applied um, generally. Rather, you need to look at the fundamentals of the business case under review before you make any application. So should you have any issue or business case where you want to apply knowledge you must have gathered from here, I will advise that you reach out to us so that we can look at the issues and circumstances holistically before advice is before steps are taken. What then is the objective of our training? The objective of this training is, number one, that participants who attend this training shall be able to understand the intention of Nigeria in adopting income tax transfer pricing regulation 2012 as amended in 2018. Then it is also expected that everyone will be able or should be able to display fundamental knowledge about transfer pricing administration in Nigeria. Three, you should be able to identify basic situations where adherence or compliance to transfer pricing regulation will be required. Then, when you now want to apply this, you then need to seek better advice on how to comply with this regulation. Just like I said earlier on, a 2-hour training on transfer pricing regulation is not sufficient to put you on an absolute stand where you are expected to know everything you need to know about transfer pricing. That is not possible. But we are trying as much as possible to uh, provide our general listeners and fellow professional colleagues with basic knowledge. But it is also important for us to stress here that should you now need uh, much more detailed training on this this regard, we are open to be of service to you. So we'll try as much as possible to make this particular topic of today very interactive as much as we could. We would it's a very topical issue within the tax practice. So please, particularly for those who want to really make more impact in tax practice, listen very well and engage me meaningfully on this note. So what is the background knowledge we need to have with regards to transfer pricing? Transfer pricing, as you see, it's something you must have talked about in performance management. It's something we are now talking about again in tax, but it is in a different light. Even though the concept may be similar, but it is in a different light. So we will have to first of all give general view about this first. Oh, I'm getting some feedback about people who cannot hear me. I needed to be double sure it's not the network of Ambrose. Now to everybody, please, if you can hear me, can you type yes on the chat room? If you can hear me, type yes on the chat room, please. Okay, so Ambrose, you might need to check your network. You might need to check your network. Thank you. So we can go on. It is no longer news that taxes are collected by countries around the world. But also, it's also important to stress that various entities across the world, particularly the multinationals, are using various strategies to minimize their tax exposure. Sometimes this particular strategy adopted by them are within the regular loopholes within the tax laws of various countries. But sometimes they are aggressive tax planning, which we may interpret as being tax evasive, right? So tax collected by various countries across the world can be reduced through various avoidance mechanisms that shifts corporate profits out of higher tax rate jurisdiction into lower tax rate jurisdictions. I'll be using a lot of terminologies in this context, but I needed to be double sure that everybody have a good understanding of basic terminologies. Can somebody on the chat room differentiate between tax avoidance and tax evasion? Which one is legal? Which one is illegal? Hello? Which one is legal? Which one is illegal? Evasion is illegal. Okay. Avoidance is legal. Okay. So it shows that we have a good knowledge of what we are talking about. So what we are now saying is that within the loopholes in the tax law across various countries, there are some entities trading or rendering their services across national boundaries. They have presence in more than one country. So they structure their tax policy or plan in such a way that the bulk of their income or profits is moved from places or countries that have higher tax rates to countries where there are lower tax rates. What do you think they are trying to achieve? Right? Everybody knows that when you declare income in jurisdictions that have higher tax rates, it then means that you will be open to paying more taxes. But when you have more income within tax jurisdictions that has lower tax rates, it then means that you will pay less tax, irrespective of how much profits that you have declared. So these are some of the strategies that multinationals have been exploiting, right? Countries around the world, they are all bothered. They now decide to come together to put policies together in such a way that the disclosures of these multinationals can be managed. Even though you say your profits legally is being attributable to lower tax regions, we need to be double sure. Are you paying the right taxes in those lower tax regions, right? So these are some of the things we'll be looking at here. The Organization for Economic Cooperations and Development has been engaged in projects to minimize tax avoidance and profit shifting strategies that exploit gaps and mismatches in tax rules to artificially shift profits to low or no tax locations. What do I mean by this? What I meant by that is that it is technically impossible for all countries across the world or all interested tax jurisdictions to assemble themselves together and unanimously have a consensus on tax matters, because this is not very visible. So we now have organizations like OECD, European Union, United Nations, coming up with various policies that could help member countries manage their tax deficiencies, right? So one of the things we'll be talking about today is a resultant effect or impact of the contributions of OECD, right? OECD, which is an international organization independent of any country, but it has various countries that are its members. So when policies that are of relevance to each of the countries are made and suggestions about the applications or transitions or the use of those policies are made by OECD, most of these countries adopt them, go back home and implement those policies. So the transfer pricing as we have it in Nigeria is one of the impact and contributions by OECD that Nigeria has borrowed from them and decide to apply it in. Are you with me? To be sure that we are all together. Can you eye me if we are together? Eye me if we are together, please.
We can hear you, sir. We can see hear you, sir.
Okay, good. Just hold on 1 minute. Okay, please, let's go on. I'm sorry, I'm having some technical issues here. Okay, so all right, so I just mentioned that countries across the world are having issues about they not receiving the right taxes based on the operations of companies within their tax jurisdictions, particularly the light of multinationals like Google, like Starbucks, and even Facebook. We can say that not entirely the profit attributable to their operations, say, for example, in Nigeria, that they are actually paying to the relevant government. As Nigeria is having that issue, Ghana is having the same issue, countries across the world are having that same issue. UN, OECD, EU, and many other organizations of that nature are thinking and making effort of what to do to help countries across the world um, minimize or possibly eradicate these problems. And what we are talking about today is a resultant effect of the contributions and impact of OECD. This is mainly put together as what we call BEPS. I'm sure some people, some of the members of this training will have heard about BEPS before. So as a tool to solving all international related tax sharp practices, BEPS was introduced. What then is BEPS? BEPS means base erosion and profit shifting. So what it then means is that this is usually peculiar to multinational organizations that has, maybe they make their income from one country and decide to say that, oh, because Mauritius is a tax haven, I will tell you what a tax haven is much more later on. So because Mauritius is a tax haven, they use their aggressive tax planning in such a way to attribute more or the most of the global profits of that organization, attributing it to be due to their branch or PE in Mauritius, while less exposure is given to other countries. So what it then means is that in the long run, they will be paying less tax even in the main countries or jurisdictions where they made their largest income or profit from. So BEPS is one of the initiatives introduced by OECD as a tool to solving this problem. So I put this as BEPS is a global problem which requires global solutions, and tax authority of the OECD countries came to understand that it was not only enough to have domestic tax or transfer pricing rules, but that an extended action was necessary in a more and more globalized economy in order to avoid harmful tax practice. So all of the things we'll be talking together, we'll be discussing today is a resultant effect of how to manage deficiency or complexities or disadvantage that comes with BEPS. 2 weeks ago, we discussed about common reporting standards. It's also a resultant effect of ways to minimizing complexities of tax in the international space. It can also be traced to contributions made by BEPS. Are you there? So findings of the work performed by OECD since 2013 confirm the potential magnitude of the BEPS issues, with estimates indicating that the global corporate income tax revenue losses could be between 4 to 10% of global CIT revenues. So what we are now trying to say that until when all or most of the countries in the world adopt these uh, suggestions, those action plans as proposed by OECD, those deficiencies we have may still continue to persist. What are we trying to say? What we mean is that multinationals across the world will still continue to exploit various countries or tax jurisdictions tax-wise. So Nigeria has kicked into this, and we want to ensure that everybody do have a fair knowledge of what it takes so that we can be better on our job, so that we can advise our clients rightly, so that we will ensure that our employers and even our clients don't have exposures that could have been avoided by a good tax plan. So base erosion profit shifting is a project announced in June 2012. It is currently championed by OECD, just as I explained earlier, and endorsed by G20 leaders to revise the global international tax system. It is also important to note that BEPS refers to tax planning strategies that explore gaps and mismatches in tax rule to artificially shift profits to low or no tax locations where there is little or no economic activities, resulting in little or no overall corporate tax being paid. BEPS is not about illegal tax fraud, but about legal ways to structure the activities of a global enterprise. I've said before at the beginning of this class where I asked the audience, what is the difference between tax evasion and tax avoidance? And we all collectively agree that to avoid tax is legal, to evade tax is illegal. So what BEPS is looking at is not about illegal strategies about avoiding payment of tax. We are looking at within the legal means, how could the various tax authority tighten the loose ends to ensure that every taxable entities pay their fair share of tax on their various taxable incomes. So we've been talking about BEPS. Just to be double sure that we are on the same page, who can tell us the full meaning of BEPS? Full meaning of BEPS, please, on the chat room. Full meaning of BEPS, please, on the chat room. Okay, so BEPS, somebody got it right. Anybody with a contrary opinion? It's base erosion profit shifting. Base erosion profit shifting. So why then is BEPS? Why do you think BEPS is actually relevant to what we are doing? Why is it relevant to tax practice of today? How do you think the action plans in BEPS will help us to minimize um, the evasion or avoidance of all of these tax that will have been paid to the various taxing authority? One of the benefits that comes with BEPS is it helps to reform the international tax system to tackle tax avoidance. So when you apply the correct propositions as contained in various BEPS action plans, you will notice that it is particularly introduced to address uh, complexities involved in international taxes, right? Just like we are seeing it in now, and we addressed 2 weeks ago, that an individual resident in Nigeria, though not an indigene of Nigeria, can have income, legal income, taxable income in Nigeria, but not disclose such to its home country. By so doing, that person will be paying less tax that would have been paid on such income. Or put in better perspective, I am a Nigerian. I have income in Ghana. I have income from Zimbabwe. I have income from Canada. But I've only disclosed to the tax authority in Nigeria that it is only, my income is limited to what I have earned in Nigeria. The tax authority will have assessed me on the Nigerian income, letting out the other international income or income from the international activities. So by so doing, I will have paid less tax than what I should have paid. So in another perspective, from another outlook, today's topic will be addressing this international tax efficiency in a different light, right? For those who missed the class 2 weeks ago, make sure that you check the video on our YouTube channel. So one of the things is that BEPS came to help us to minimize, reform the international tax system to tackle tax avoidance. The second one is that it helps to mitigate continuous reduction in the tax revenue generated or to be generated by countries due to sharp tax practices by multinational enterprise. So if countries are now rigidly applying all of these BEPS action plans, in the long run, we will then to see that the tax revenue generated by each of these countries will improve compared to what it used to be, right? Another reason, benefit of BEPS is that it ensures that profits are taxed where economic activities takes place and where values is created. So some of these multinationals, it does not mean that they don't want to pay tax, but they would rather prefer their tax being paid in some jurisdictions against or as contrary to where the money or the income were actually generated. So BEPS seek to address that concerns, that taxes, appropriate taxes should be paid in jurisdictions where the income or the profit actually arose from, right? Then another one is perceived inequality in taxes paid by multinationals. So we want to, by virtue of this BEPS principle, we want to ensure that every company, particularly the multinational, pay fair and fair, I mean, pays fair share of the taxes based on the income and the profits they have made. So BEPS also gives rooms for more transparency from most of the multinational entities, and complex tax structures adopted by these multinational entities as tax planning are actually worked on or managed to ensure that irrespective of those structure or strategy you are putting in place, you pay what should be paid. But please, I need to sound this note of caution. Transfer pricing we are looking at today is not a form of tax, right? It's not a form of tax. It's a form of declaration and disclosures. But you and I know that if you don't disclose rightly, then the bottom line as tax payable will not also be correct. So what we are looking at today is what disclosures should liable persons make when this issue relates to them. So what then is the timeline for BEPS? Initially, we said that the BEPS project was announced in 2012, Um, document relating to BEPS was released. Document relating to BEPS was released in February 2013. In July 2013, action plans with 15 separate actions were being published, right? We'll be talking about these action plans much more later on as we continue with these slides. You will then see that the transfer pricing we are talking about here is one of the 15 action plans as proposed in the as contained in the BEPS strategy proposed by OECD. Then in November 2014, the G20 leaders, Brisbane had a meeting. They deliberated over it and approved that these particular principles or strategy can then be adopted, right? Between July 2013 and May 2014, there were stakeholders' input, right? Stakeholders have to also look at what has been adopted and decide to make their input either by virtue of making additional contribution or proposing that one or two of those options or strategies be removed. Then by September 2014, G20 finance ministers meet in Cairns. The September 2015 completion of the remainder of the action plan was also initiated. October 2015 released final report on 15 focus areas in the action plan. Then with effect from 2016, onward monitoring additional and ongoing actions. Does it mean that as we speak today, there are no further actions on BEPS? No. The improvement, additions, subtractions, or better ways to manage this international tax crisis are still undergoing various discussions. But the essence of this particular slide is just to tell you when did the discussion to addressing these international tax concerns began. It all began in 2012, and as we speak, member countries are still engaged in various discussions on how to manage this international tax crisis. So that brings us to, first of all, give this highlight that the income tax transfer pricing regulation we are talking about today was actually, first of all, introduced in 2012 in Nigeria, but no meaningful impact was made of it until 2018. And that tells you that as at that 2012, when the regulation was introduced, everybody has not had a clear implementation plan of how this should be what? Implemented and administered, right? So until 2018, an amendment was made on that 2012 before application and the administration now became effective. I'll be talking much more about that as we go on, but just trying to relate that to this timeline. It all begins in 2012, but as we speak in 2021, more as OECD tries to cover up more loopholes are being identified. So I foresee this particular discussion going on as long as we have taxes payable across the countries, right? So I believe that is understood. So we'll be talking about multinational organizations putting up various tax strategies as a way to avoiding tax. We'll be taking into cognizance one of those multinationals and have a quick run through them. Let's see what it actually takes and in does this, how has this impacted them and what feedback do we have on that? So we'll be having a look at an overview of a multinational. A typical example we have picked for the purpose of this discourse is Starbucks. So Starbucks is a multinational company that sells coffee, right? So this company has a market capitalization of $40 billion as at 2012. Is the second largest restaurant or cave chain globally after McDonald's, right? It's also a United Kingdom subsidiary established in 1998. What I mean by that is that they have they established a United Kingdom subsidiary in 1998. As of 1998, they have a total income of over £3 billion. Income tax paid since 1998 to the time of this discourse is about £8.6 million. So if you look at the proportion of the tax that they have paid and the proportion of the total income, it looks very, very small, right? They are probably doing less than 30% of their actual income. So what then could have accounted for this? Consistently, they have reported no profit and paid no tax from its sales of over £1.2 billion. Then compared to McDonald's, right? McDonald's had made a sales within that same period, made a sales of £3.6 billion and paid tax of about £80 million. And if you also have to compare this with KFC, this company, which is also a multinational, has made a sales of about £1.1 million and paid a tax of about £36 million. So these are three different multinationals having similar organizational structure. They have all make taxable incomes, but the taxes that they have paid, you can see the sharp differences, particularly between Starbucks and others. You've seen. So what it then means is that Starbucks must have put forward an aggressive tax plan that may be synonymous to what we call BEPS. Are you with me? So in my next slide, you'll be seeing some of the strategy that Starbucks put forward. So Starbucks, which is the company the multinational we are looking at for the purpose of this discourse, they have their headquarters in Amsterdam. Who can tell us where Amsterdam is and what is the relevance of Amsterdam in the international tax space? Does anybody has any idea? Amsterdam is where? Okay, what is the relevance of Amsterdam within the international tax space? What can you identify with Amsterdam? No response on that. Amsterdam is a tax haven. It's one of the tax havens. Yeah, it has a friendly tax jurisdiction. So it's one of the tax haven. You'll be getting more insight about this as we go on. So look at the structure that this company has put forward. They have identified a tax haven and decided to make their headquarters established in a tax haven, right? So they have Starbucks Amsterdam, they have Starbucks UK, and they have now look at the structure they now put forward. So if Starbucks UK will have to pay royalty for brand and business process to Amsterdam. Why? Because they know that if all the incomes are in UK, they will pay more tax, right? So they have to shift these profits to Amsterdam by putting forward that UK is enjoying the brand created by Amsterdam. As a result, they have to pay hugely for this as a what? Royalty, right? So if you look at the movement, you will see that most of in certain places the real income were generated, but through tangible and intangible assets or franchise, these profits are being shifted from the places of higher tax jurisdictions to the places of lower tax jurisdictions. So let's also see what happens between Amsterdam and UK. If you look at it, I believe you can see my cursor. Um, as Amsterdam, UK transfer roasted coffees to UK. What could have been manufactured in UK, right? They assume that it is being transferred from from Starbucks Amsterdam to Starbucks UK, who will also in return pay a share of their profit of the value created. So you will see that through two different means, profit has been moved from UK to Amsterdam, right? The third one is um, you have coffee being bought as bean from from this one is to be Netherlands, please, right? So they have this particular profit being shifted. Why are they buying? It's also a way of actually trying to move the money that would have been tax in UK to other tax havens. So the whole of this structure you have seen is a similar structure that most multinational have been adopting as a way to actually shift their profits from jurisdictions that has higher tax rate to jurisdictions of lower tax rate. I believe I've been able to make this clear. But if you don't understand, let me know whether you actually understand or not. If you understand me, say hi on the chat room. Good. If you understand me, say hi on the chat room. All right. All right. All right. So we are good to go then. We are good to go. All right. So the end point at the end of our discussion is to relate all these BEPS principles to the transfer pricing regulations we have in Nigeria today, right? But this is all and how it started. Then what then is a tax haven? What then is a tax haven? We've been mentioning that some countries are tax haven. Is Nigeria really a tax haven? We will have to say. So you said a place or a jurisdiction is a tax haven if the following exists. International tax planning has evolved around playing the rules of one tax jurisdiction against another by exploiting loopholes in the local tax legislations of each jurisdiction. So in the tax haven, it does not necessarily mean that they don't pay tax at all, but some, no taxes is being payable. But to others, the taxes payable are very, very, very low. So it also basically involves the arrangement of transaction in such a way to move profits from high tax jurisdictions to low or no tax jurisdictions. These jurisdictions are known as tax havens. So tax havens are tax jurisdictions that have friendly tax policy. And you say something is friendly when it is uh, comparatively low or you don't have any tax exposure at all. So OECD key factors in considering whether a jurisdiction is a tax haven, right? OECD key factors in considering whether a jurisdiction is a tax haven. So these are the characteristics that OECD has put forward as ways of identifying tax haven. So if you now identify or see any jurisdiction having these attributes, you can simply call them tax haven. So one of those attributes is that there is either zero tax or low tax rate in those countries, right? That's one. Two, there is protection of personal financial information, right? This set of countries that we regard to as a tax haven, they don't just release informations of persons and entities anyhow, right? And of course, there is lack of transparency. So any of those, there are still some other attributes, but these are the main common ones as proposed by OECD. And when you see this attribute, you then know, or you can then deduce or interpret those jurisdictions as tax haven, right? So for the purpose of your understanding, we have tried to survey what are some of those countries that have these attributes that we have earlier mentioned. We have the British Virgin Island is a common tax haven. Simon Island is a tax haven. Luxembourg is a tax haven. Mauritius is a tax haven. Netherlands is a tax haven. But I want to give the audience who are also informed about tax haven to mention any example of tax haven. Okay, people have even been contributing. Switzerland, yeah, Switzerland is a very good example of a tax haven. All right, any other one? Any other one? Any other person that has an idea of what a tax haven, I mean, of example of tax haven? A typical way of you also identifying what a tax haven
Pass.
is. What gives you an insight of what a tax haven is? It's
Ozaza,
one of
come.
the
Yes.
places.
Come. What?
So a typical example of what a tax haven is those places that the common politicians that you know, the places they sometimes go to keep those money, right, can also be likened to be a tax haven. Remember the attributes we gave to a tax haven. Let's go back to it. We said there is zero or no low tax rates there. There is lack of transparency, protection of personal financial information. So if you now relate it to those sharp practices by some of those notorious politicians, because they see all of these attributes and they know that all of these attributes will favor their intended action, they shift those resources there, right? So as we go on, for the benefit of those who just joined along the line, what we've been discussing thus far is what's what is transfer pricing regulation in Nigeria? How does it come to play? What are the history behind this? And what is the concept around BEPS? BEPS, what is the meaning of BEPS? And what are the basic attributes of what a tax haven is, right? If you remember some of my slide before now, I mentioned that OECD has been one of the front runners is in trying to helping countries across the world to minimize some of these international tax crises faced by various tax jurisdictions, both the developed countries and the developing countries, right? So one of the initiatives that OECD came up with is the BEPS principle, right? And as a way to solving some of these international tax crises through BEPS, there were 15 action points that were proposed. We'll be looking at these action points now as we go on. Okay, Darlington also mentioned to us that Malta, Chile, Hong Kong, Liberia, just to mention a few, are some of the tax havens that we have. Very correct. Very correct. Thank you. So, Organization for Economic Cooperations and Development is championing this change among its members to substituting rules and has set out 13 reports, including 15 action plans to addressing the menace of base erosion and profit shifting as follows. So what are these action plans? What we mean by the action plans is that what it has proposed that member countries should do as a way to, minimizing or increasing their tax collectible or revenue in their own countries. So action point 1 is that it seeks to address the challenges of the digital economy. The major problem that we face by most of these international organizations or multinational organizations is that most of them operate digitally. So there is then a problem of how to tame them to a particular country, right? So digital taxation has now been addressed by this action point 1. Maybe in the nearest future we'll be also be putting forward a training on taxation of digital business, right? It is currently applicable in Nigeria, and that is one of the reasons why you see that the Nigerian government is indirectly accusing Twitter and some other digital business as not paying their fair share of taxes into Nigerian um, authorities. So that is the first one. It seeks to address the challenges of digital economy. How do you tax organizations that operate digitally? How do you tax businesses that operate digitally? That is the action point 1. 2, neutralize the effect of hybrid mismatch arrangement, right? All those structures that you could, plans or strategies that you could put forward that looks as though you are operating partially physically and partially virtually. So that has been addressed by the action point 2. Then 3, strengthen control foreign corporations. Control foreign corporation, we call that the CFC rules. Those are foreign establishments that looks as though they are not independent of their own, right? How do you manage that, right? So that is being addressed. We have a lot of those multinationals that have that structure. Then the fourth one is limit base erosion via interest deductions and other financial payments. Okay, this is before 2019. Nigeria does not have what we call thin capitalization. Thin capitalization, but with effect from 2019 Finance Act, the thin capitalization policy has then been introduced, right? And that seeks to address the concerns around limits-based erosion via interest deduction. So, but let me throw a little light on this. Most of the time when foreign companies are coming into Nigeria as well as other countries to establish, the nature of the business may demand them to put in forward, let's say, for example, 100 million as a capital base. But they know that if they put forward all the 100 million as a capital base, a lot of structures, policies, and laws are put in place to ensure that there is no capital flight. Capital flight means that at the end of the day, they don't just take away all the incomes and the profits as well, as well as their capital. It is not being carted away, right? So because of these rigid policies, they now put forward this. Instead of bringing forward the whole of the 100 million as capital, they can do 10 million as capital and 90 million as loan. You know, the attention of the government is on dividends you are paying to your shareholders, right? Because they have now structured it in ratio 10 to 90, say for example, right? They structure it in ratio 10 to 20 or any ratio that they deem fit. By the time the attention of the government will be on whether they are paying dividends or not. Meanwhile, because the bulk of their money is as loan to the company, the government may not be paying attention to who is actually collecting the the interest on the loan. And meanwhile, they will have also put forward ambiguous rates on the interest. Imagine, let's assume that the prevailing interest rates for any loan you want to take in Nigeria today is, let's just say, is 10%. They can put forward their own at, say, 35%. Their intention is that they want to take the profit of the business away as soon as possible. We call that capital flight, right? So if you now use this, because there is no existing standard ratio before 2019, businesses of that nature can put forward any ratio of their choice. But with effect from 2019, right, there is now a minimum ratio that should be the proportion of your equity to debt instrument, right? So the proportion of your equity to debt instrument, particularly when the debt is exceedingly much more than the equity, is called thin capitalization, right? That is what I mean by the thin capitalization. So Tijani, I believe that answers your question. The proportions of a company debt instruments to their equity is called thin capitalization. So when a company has more debts than its equity, or what we simply call share capital, we say that company is thinly capitalized, right? That company is as good as being liquidated. So if the debt holder decides to say, we are taking all our money out, then the company will be left to little or nothing to run the business. So these are some of the ways that these multinationals have been operating before. They bring in more debts than equity. And while the attention of the government is on the debt, right? While the attention of the government is on the equity, they are cutting away all the profit as interest on the debt, right? So, but with effect from 2019 Finance Act, there is now a standard ratio for that. So that is what, that is because they got that particular insight from one of the BEPS action plans, right? So number 5, which is the 5th action plan, is counter harmful tax practice more effective, taking into account transparency and substance. Counter harmful tax practice more effective than, taking into account transparency and substance. Okay, somebody is asking me, what is the standard ratio for equity to debt? Let me put the question to the house for. Let me see whether anybody has an idea who can help us with answer to that question. But if none, I will then propose. I will then make put forward the answer. Anybody who knows the standard ratio as contained in our last amendment to our tax law on thing capitalization? Anybody? Wow, that's strange. Okay, so the existing structure is that it should be a minimum of 70 to 30%. Your equity must not be less than 70%, while your debt should not be more than 30%. So it's 70 to 30. So when you are advising a client on bringing in that it's intended to setting up, and they are looking forward to what could be, or does Nigeria has any policy around the proportion of equity to debt, right? Nigerian do have, so your answer should be yes. And what is the ratio? Is 70 to 30. All right, so we can go on. So we've mentioned the first 5 action plans. Let's go to the next one. Each of those action plans is a topical issue on its own. Each of these action plan is a topical issue on its own. So action plan 6 is to prevent treaty abuse. That is double taxation agreements and other tax treaties made by or between various tax jurisdictions, right? Then prevent artificial avoidance of permanent establishment status, right? It is from this you now have a clearer definition of what constitutes a PE, permanent establishment, not physical education, please. Then action plan plan 8 is assure that transfer pricing outcomes are in line with value creation. So that's part of the things we're looking at today. Then 9, assure that transfer pricing outcomes are in line with value creation, but relating to risk and capital. That is also part of what we'll be looking at today. And then 10 talks about action, assure that transfer pricing outcomes are in line with value creation's high risk transactions. That is part of what we are looking at today too. Establish methodologies to collect and analyze data on BEPS and the action to addressing it. We have taken this last week. That is relating to CRS. That is relating to CRS. Then 12, require taxpayer to disclose their aggressive tax planning arrangements. Then 13, re-examine transfer pricing documentation. Then 14, make dispute resolution mechanism more effective. Then 15, develop a multilateral instrument. So among all of these action plan proposed by BEPS through OECD, 4 of them relate to transfer pricing. We'll be talking about the first 3 today, while the fourth one may not be available through a public training because it is the cash point in the tax practice in as far as transfer pricing is concerned, and the issues around it cannot be totally handled within the limits of these 2 hours training. But we'll be magnanimous enough. We are magnanimous enough to share with the public what's part of this transfer pricing, at least the first 3, that could improve your knowledge, and you have requisite knowledge about it. So by way of extension, we've said that action plan 8 to 10 and 13 of the OECD reports on BEPS action plan addresses transfer pricing. That tells you how important TP is to various tax authorities and aggressive tax planning carried out by various multinationals. So I'll take this again and put more light on it. How can tax be managed around each of them? We've said that action plan 8 talks about how to assure that transfer pricing outcomes are in line with value creation, intangible. So if you remember the illustration I put forward under Starbucks, when the UK branch or PE has to pay the Amsterdam headquarter, right? What are they paying for? They are paying for brands. They are paying for patent rights. They are, all these brands, patent rights, they are all examples of intangibles. Because it is very difficult to actually put values to this. This is one of the ways that multinationals use to actually shift profits from higher paying tax jurisdictions to lower paying tax jurisdictions. They will then put forward a policy that, oh, those their branches or PEs in the higher paying tax jurisdiction has to pay XYZ blah 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 as intangible to the lower paying tax jurisdiction. To a layman, you'll be looking at it that, okay, yeah, there is a rationale behind doing that, but what is the reasonability of the measurement of those intangibles? If you remember what IAS 38 talks about accounting for intangible assets, the standard goes further to telling you that certain categories of intangible assets cannot be accounted for, should not be even be recognized in the books, right? How then are these multinationals, how have they valued these intangibles before they expect that XYZ payments should be made for it, if not being used as a tool to manage your tax exposure? Then action plan 9 talks about assure that transfer pricing outcomes are in line with value creation. But this one is now looking at risks and capital, right? What this one seeks to address is this. There are scenarios whereby a multinational will have another branch in a different tax jurisdiction. They will provide capital for those for that their jurisdiction to operate where it has been established. But if you look at the capital and the returns that comes with that capital, ordinarily within the business management, they will tell you that if there is low risks on the capital you have given out, then the interest or compensation that comes with it should also be low. But the higher the risks, then the higher the returns. Most of the time, the capital or the offer they have made is usually with little or no risks. Meanwhile, what they are cutting away is on the assumption that the interest that comes with it or compensation that comes with it also compensate them for risks that are not in existence. So transfer pricing seeks to decouple the components of this compensation and ensure that the ones that are arbitrarily are adjusted for as appropriate. Then action plan 10 assures that transfer pricing outcomes are in line with value creation, high risk transactions. So you will then have to look at transactions between related entities and compensation that comes with it. Is there any risk embedded in those transactions they are doing? And why should compensation higher than what would have been available in an arm's length transaction being adopted for these transactions? That is what action plan 10 talks about. Then the action plan 13 that I said is not within the scope of this training, but also expected to be known by every tax consultant, is to re-examine transfer pricing documentation. We call this in practice contemporaneous documentation. So, but contemporaneous documentation is entirely talking about if an entity transact businesses with related entities or related parties or control parties, right? Or control persons. And you know that these transactions are usually will continue indefinitely. It is now expected of you to have a policy similar to what we can call an agreement about the nature of the common transaction or the control transaction we are likely to have and what price should be attached to that, or how those pricing should be made at every point in time. So this is also a very important document. Every organization is expected to maintain. Organization that have TP exposure is expected to maintain it, right? So let's go on. I hope I'm not too fast. Let me hear from the public. All right, so let me know, am I too fast? Yes or no? Hello? I want to hear from you. Am I too fast? Yes or no? Okay, good. Okay, good. We're on a good note, so we can go on. We can go on. Please, because of time management, let's suspend every question to the end of this class. We will give ample time for questions. We will give ample time for questions. Let's ensure that all questions are suspended till the end of the class. Thank you very much. We still have a lot to talk about. So now the journey has now begun. Everything we have done before now is just to give a preamble to what issues that give rise to what we are actually talking about. What is the journey thus far? How does transfer pricing come to play? When we say transfer pricing, does it mean Nigerian government just wake up one day and decide to call something transfer pricing and enforce it on every liable persons? No. So if you trace what we have explained thus far, you will know that, oh, this is a topical issue and that is not only affecting Nigeria, but affect most other countries. And there is need for a collective effort to actually addressing this concern, right? So what then is transfer pricing? I put this as transfer pricing generally refers to how related parties price goods and services, assets, intellectual property, loans, guarantees, and other commercial transactions between them, right? So having known that transfer pricing is all about how you attach price to the goods you are selling and prices or services you are rendering or opportunities that you are giving to others, but to who now? Related party. That then will then make us to draw more light on who or what a related party is, right? Organization or entities that are under common control is a simplest way to explaining what related party is. So if you have two or more businesses that are owned by the same person or owned by common shareholders, or they have common management being that are responsible for the day-to-day affairs of the business, we can say to an extent there might be significant influence or a controlling impact on actions or inaction by these distinct entities. Because of that, we say they are related entities. So if these entities now have reason to render service or sell goods to each other, there may be possibility that these services or goods will not be sold or transacted to each other at the price they will have sold or rendered these services to parties that are not related to them at all. So because of this unfair pricing mechanism, there is then need for us to be deliberate about what could be the impact of these unusual or unfair prices on the taxes that these companies will pay, right? So what impact has this form of pricing if the transacting related entities are located within the same tax region? So if you have common parties that are related and transacting businesses on an arm's length transactions between each other, or not using an arm's length transacting prices amidst each other. What impact do you think that will have? So what impact do you think that will have? So it is very important for you to say that if these transacting entities within Nigeria, if they don't have any tax holiday, provided they are in Nigeria, there may be little or no impact. But if one is enjoying tax holiday and the other one is not enjoying tax holiday, the management may attempt to be shifting the profit of the one that is not enjoying tax holiday to the ones that is enjoying tax holiday, by so doing, managing their tax exposures. However, whether the related entities are within Nigeria, are all within Nigeria, or beyond the Nigerian tax jurisdiction, they are all open and should be liable to complying with the TP regulations, right? So what then will be the impact if the transacting entities or pricing between the transacting related entities are located at different tax jurisdiction? So it then becomes much more glaring that this may be related to some of the issues we have earlier explained, that the company, the representative of the company in Nigeria, the PE in Nigeria, may deliberately be using unfair prices for because they actually want to bring in more profit here or take out more profit here, depending on what is the strategic intent of the management. So either ways, there will be an exposure, and this regulation has been introduced to ensure that, first of all transactions between related entities should not be reported differently as it will have been if you are transacting with an unrelated entity, right? So that is number one. So transfer pricing, is transfer pricing a tax? I've said it at the beginning of this section, that transfer pricing is not necessarily a tax, right? It is primarily a disclosure requirement. So I put this as transfer pricing is not another form of tax, rather a disclosure or declaration requirement to ensure that the responsible entities are open to TP risks, as a tool to addressing false or reasonable tax compliance. So it is not, we are not saying that companies or entities or related parties that have exposure to transfer pricing are paying another form of tax. But if they have used prices that are not at arm's length in carrying out their transactions, at the end of the day, after the adjustments are made, it may then increase or reduce the taxes that they had already paid before. So unlike taxes enacted in Nigeria by substantive tax laws such as PITA, CITA, CGTA, PPTA, VATA, etc., transfer pricing is regulated by a legal document known as Income Tax Transfer Pricing Regulation 2018. You remember that I said that the first time this regulation was introduced in Nigeria, it was in 2012. And I've also said that this is not a new tax, rather it is a disclosure requirement, right? So, but anytime we want to make references to the components or the provisions of this regulation, how do we identify the document? If it were to be a law relating to personal income, we say it is from the Personal Income Tax Act. If it is relating to company income, we say it is based on the Company Income Tax Act. If it's relating to capital gain, we say it is based on the Capital Gain Tax Act. Petroleum, we say it is related to the Petroleum Profit Tax Act. VAT, we say it is as contained in the Value Added Tax Act. How do we reference this? We must say that it is as contained or whatever in the income tax, put in bracket, transfer pricing regulation 2018. I believe that is clear. So still under the canon that is transfer pricing a tax, it is still not a tax, but transfer pricing regulation in Nigeria as contained in section 1 of the income tax transfer pricing regulation 2018 does not just come from the air, right? We've said that, oh, the earlier drafter of our various tax law have in mind that sooner or later there could be what we call artificial transactions, right? It's just that as at then, when those laws were embedded, they just call it artificial transactions. But this TP regulation now throw more light on what constitutes an artificial transactions. So artificial transactions are recognized in our Personal Income Tax Act. It was recognized in the CIT, in the VATA, in the PPTA, in the Capital Gain Tax Act. So it is on that platform we can now say that technically transfer pricing, income tax transfer pricing regulation actually drew its relevance from our existing and various tax laws. What is the objective of the TP in Nigeria? Section 2 of the Income Tax Transfer Pricing Regulation 2018 put forward the following as the intent or the objective of the TP regulation in Nigeria. 1, that tax should be on appropriate taxable basis, right? That every taxes payable in Nigeria, whether by local entity or multinational entity, should have an appropriate base, right? Not that some businesses will have shifted their profits to another tax jurisdiction and the tax authority will then be applying the tax rate on a wrong basis. So the number one intention of the TP regulation is to ensure that there is a fair and reasonable or put as appropriate taxable basis on which all taxes should be paid. Then 2, it also seeks to provide tax authority with the tools to combat tax evasion that may emanate from transfer pricing issues, right? Because both the taxpayers and the tax administrators have undergone similar training that will make them to understand various manipulative strategies that various businesses may want to put forward as tax planning. Because they already have an hands-on knowledge on this, they will then have to review or assess every liable transaction to ensure that there are no ghost hand involved. Then the third one is to reduce the risk of double taxation. I mean that as taxation, double taxes. So transfer pricing does not want to expose anybody or any entity to double taxes, but ensure that you pay as reasonable and fair to the responsible tax jurisdiction. Then the fourth one is to provide a level playing ground for all businesses. No partiality, whether you are small business or whether you are local business or you are international business. Then, of course, provision of certainty of transfer pricing treatment. So everybody will then understand that when certain area of transfer pricing risks arises, whether relating to capital and risks or intangible or any of the other issues that we have mentioned earlier on, how do you reverse the abnormality embedded in every transaction to ensure that the tax base is being adjusted as expected? So these are the major objectives as contained in our income tax TP regulation 2018. For more information, you might choose to go and make reference to this regulation. Is available everywhere, including the FRS website. We can also check our websites for it. I think we have also uploaded it for reference purpose. All right, so next one is we've talked about section 1 that actually introduced the regulation and give it its name. Then we'll talk about section 2 of the regulation that talks about the objective of the regulation itself. Though we will not go through all of the regulation because of time, but we have taken time to pinpoint the relevant areas that you need to know. But if you now seek more detailed knowledge, you might make reference to the regulation in proper. It's about 43 pages, so it's something anybody can read, can complete within few hours. So section 3 of the TP regulation talks about the scope of the TP practice or administration in Nigeria. So what this means is that what are the categories of transactions that may have TP exposure? So anytime any related party or connected persons carries out any of the aforementioned transactions, there might be embedded TP risks there. Number one, whenever they sell or purchase goods or services from each other, we must ensure that these transactions are carried out at arm's length. Otherwise, there is TP risk. And we've also mentioned why or what they might be trying to achieve for using abnormal prices. Then two, when they sell, purchase, or leases tangible assets to each other. So whenever they have lease arrangements whereby maybe they outsource one asset or the other to each other, they must also ensure that this leasing or the pricing or as compensation for this lease must be what they will have ordinarily charged if they were giving this facility to a non-related entity. Otherwise, there are TP risks embedded. Then the third one is transfer. When they transfer, when they purchase or license or use any intangible asset. You remember this is action plan 8. That talks much more about that. So whenever they share intangible assets around between related parties or anything of such, whether in terms of transfer, purchase, or license, we must ensure that if they had wanted to transact this with a non-related entity, how much would they have charged? Are they charging the same price as they will have as they are charging among related entities? For those who are abreast of the brouhaha of Stanbic IBTC some years back, you will remember that Stanbic IBTC Nigeria had some issues with FRCN with respect to their intangible transaction between Stanbic IBTC Nigeria and Stanbic IBTC South Africa and other branches or P's of the company. Then fourth one is provision of service. When they render services to each other, it's also within the scope. But whichever or in whatever form this transaction occur, the intention of transfer pricing regulation is to just ensure that prices that you charge is fair. If a non-related party comes to you, it is the same price or amount you have levied on your related party that you would have also levied on non-related party. Then when they have lending or borrowings of money between each other, when one party among the connected person lend money to the other or borrow money from other, the compensation for the lending or borrowing or the cost of the borrowing, is it at arm's length too? Is it the amount that they will have given or obtained loan from a non-related party? If not, the appropriate adjustment or amendment has to be made. Then when they have manufacturing arrangements whereby one of the correct connected person will manufacture and transfer to the other party who will advertise and transfer to the other party who will sell and all of that. They should ensure that the prices they are charging at each level of service of goods sold or transacted are at arm's length. Then any other transactions which may affect profits or losses or any other matter incidental to connected persons or pertaining to transaction between the connected persons as noted in 1 to 6 above. So all of these or anything, simply put, anything that the connected persons are doing that will affect the amount of profits that is open to tax, it's said to have it's said to be within the scope of transfer pricing. So who are then the connected persons? Who are connected persons? I want to hear from you. Who are connected persons? If you know what connected persons are, can you put it on the chat room? Hello, are you there? If you know what connected persons are, okay, somebody just mentioned parents are subsidiaries. Yeah, they are connected persons. Who else? Connected persons are two subsidiary entities within the group, yes. Transaction between the directors of a company and the company itself. Can we say they are connected? Yes, they have. Shareholders and the company, they have. They have. So all of these arrangements, so we are looking at when you say you are conducting a TP risk assessment, what you are then trying to do is to assess whether all the transactions carried out by this entity during the period under review are in any way carried out with connected persons. If they are carried out with connected persons, then there may be embedded TP risks. Now, when there are embedded TP risks, you need to remove the veil and ensure that have those connected transactions be carried out in line or in a way that the regulation actually provides. So transactions between connected persons are expected to be carried out at arm's length. A control transaction is at arm's length if the conditions of the transaction do not differ from the conditions that will have applied between independent persons in comparable transactions carried out under comparable circumstances. So it is not a big deal carrying out a transaction between connected persons, but what the regulation just wants to be sure is that you have charged or collected pricing at arm's length. So where a connected person fails to comply with the provisions of this regulation, the service will make adjustments where necessary in order to bring taxable profits resulting from the transaction in conformity with the arm's length principle. So for tax persons amongst us, you then need to improve your skills around this because FRS has started it. They've been selecting some companies for what we call the TP audit, right? The common form of audits we've been used to is payee audit, withholding tax audit, value-added tax audit, company income tax audit. So in the same manner, because we have entities that are open to TP risks, FRS may spot your client for a TP audit. So it becomes very, very important for us to actually improve our skills in this area. And I tell you, for the small players amongst us, right? This is the big advantage that the Big Four has over most of the small companies, right? But this competence is available for every one of us. If KCP can do it, every firm can do it. So I will encourage firms owners or representative on this platform to ensure that you can reach out to us. You can reach out to any other firm that can offer similar training that will better position you to ensuring that you and your team have requisite skill to addressing this concern for your existing clients. That's one. Two, after this training, I'm also encouraging you to possibly have discussion with us. Let's overhaul your client base to identify whether your clients may have TP risk, right? Because the returns and disclosure that we'll be talking about later on should also be made for every client or taxpayers that have these risks. And the penalties are very, very outrageous. So we need to ensure that our clients does not have this exposure. What do we need to do to ensure they don't have this exposure? We need to advise them promptly. We need to ensure that we acquire the requisite training to better position ourselves to servicing them better. Otherwise, the danger there is that sooner or later, anyone who does not take action may be losing those clients to the giant players. Then to the regular ones who are employee amongst us, it is also relevant. This topic is also relevant to you because as you aspire to getting better engagement or grow within the organizational ladder, the way your organization, your employer does their transactions, some of the business arrangement they may be carried on may also have TP exposure. So when you are better informed, it puts you in a better place to render relevant service to your employer and be more relevant to the business of the company as they expand. So we also have more structured training for people of that caliber who just want to improve their skill and knowledge in this regard. What we have offered to the public in form of this public training will not definitely hands you or equip you with all that you need to be a proficient player in this regard. But this is just a tip off that you should make more conscious effort to grow in. So we are still there. We are still there. Transfer pricing methods. We've talked about what transfer pricing is, the scope of transfer pricing, the nature of a transaction that may have transfer pricing. And if you have been very attentive, you will notice that we've been agitating that transactions of transfer pricing risks must be carried out at arm's length, arm's length, arm's length. Within the scope of the regulation, Section 5 precisely provides the various methods at which you can value various transfer pricing liable transactions. So we have the following, basically 5. The first one is the comparable uncontrolled price method. The second is the resale price method. The third one is cost plus method. The next one is the transactional net margin method. Follow with the transactional profit split method or any of the methods prescribed by the FIRS from time to time. How do you know what method will be suitable for a particular transaction? It is all transaction dependent. It's all dependent on how much information you have at your disposal. Which of this method particularly will be suitable to the attributes of the transaction we are looking at? Say, for example, if you have connected persons and you are rendering a service to the other connected person, if you are rendering service, you will note that you can either use the number 1, which is the comparable uncontrolled price method, or you could use what we call the cost plus method. Let me explain what I mean by that. Using using the comparable uncontrolled price method then means that, say, okay, let me use my company for example. KCP has 3 major departments. Let's pick the first 2 amongst them: audit department and tax department. If tax renders service to audits, right? How could tax render service to audits? You are carrying out an audit and you need to validate the tax provisions that should be used as input in that audit. We need to send it to the tax department. They will do the computation and send it forward to the audit department. But if you have to look at it in the light of this transfer pricing, they are connected. They have rendered service to them, particularly if these 2 departments are operating independently, right? So at what price should tax department raise invoice on the audit department? The question we would then ask is this: if our tax department had wanted to render that kind of service to an entity that is not related to us, how much will they have charged for that service? Let's say, for example, the amount they will have charged is 500,000. That is the amount they will have charged any other person. So what this transfer pricing method is then saying is that that is the same amount or invoice you should raise on your related party. So if you are using that pricing method, we will say that we are using or we have used the comparable uncontrolled price method, right? Then I said that for that same transaction, too, you can still use the cost plus method. Cost plus method could then be that, okay, how much does it actually cost us to render that service? We will then put a margin on it. If it is the policy in our firm to always make, let's say, 45% margin on any service we are rendering, we will now have to look at how many staff work on that CIT computation. What is the time value of using those staff on that particular assignment for that period? Let's say it will cost us 150. That is the hourly rate for all the staff that have worked on that. And our margin is, say, 50% of anything we are doing. So the cost plus method then means now that we are raising invoice on the audit department. Invoice of how much? 150 plus 50% of that 150. That will give you about 225,000, right? That is using the cost plus method. The resale price method may not be relevant in a service industry, right? But will be relevant in a manufacturing or in a trading industry where you have bought something, you want to sell it, but your related entity say that rather than selling it to outsider, why not sell? Please, if you can hear me, can you say hi? There is a disruption in my network. All right, thank you. So as I was saying, okay, thank you. As we're saying, the resale price method is then means that you are using the price that you will have charged when you resell that product. That same price that you will have charged a non-connected person is what you should also charge your connected person resale price. You bought a laptop for 150,000 and ordinarily you will have sold it for 250,000 and your related party needs that laptop. Since it is 250,000, you will have sold it to a non-related party. This resale price method is also saying that sell it to that your connected person at that same 250,000. Then I'll explain the first 3. The next one is the transactional net margin method. It's somehow related to the resale price, but in this instance, you are charging a certain percentage as margin, not as cost. If you look at what I explained under cost plus method, you are charging your profit, the supposed profit or gain you will have made on the cost. But this one, you are making your estimate of profit on your sales. Remember what we talked about when we calculate markup and margin. That is just the difference. So then the last one, which is the transactional profit split method. This one is very relevant when two or more connected persons has jointly carried out a service or jointly sold certain goods and they want to share the returns from it, right? So what they will then have to do is they will jointly incur the costs, make the publicity and all of that. Then the profit element on it, they will have to share it as a proportion of their own contribution to that bottom line. So that is what that is all about. I believe you understood that. The standard expect that, the regulation provides that any of these method that is peculiar and suitable to the transaction at hand could be used by connected persons when valuing transactions of that has TP risk. So, and we just want to emphasize that it is important to note the following, that the following may influence your choice of the above method. How appropriate is that method to the transaction at hand? How many available, reliable information do you have to be able to use one method as opposed to the other? What is the degree of comparability or cooperability between the controlled and uncontrolled transactions? So you need to look at all of these parameters or functionalities to be able to determine which method is suitable. Then Kaede, because of time, I'm so sorry. You will have to repeat this question again. Let me just quickly round up. We're almost there so that we won't leave any stone untouched before we close up, right? I'm so sorry. So the following should be noted in TP. I've explained what a control entity is. Functional analysis, you do functional analysis when you are trying to appraise the system, appraise a connected person to know their own peculiarity, right? You do also comparability analysis when you are trying to see what will be the comparable factors amongst the connected persons and the unconnected persons. Then advanced pricing agreement. Sometimes all the aforementioned methods may not be suitable because of the peculiarity of the transaction at hand. You may then have to engage the FIRS to have an agreement with regards to the pricing you should use for certain transactions between the connected person. So when you do this, that is what we call advanced pricing agreement. Then tested parties are parties that have been tested to being open or having the TP exposure. The benchmarking studies. Sometimes when you don't have a ready-made market to identifying what particular value or amount should you use for certain transaction, you might need to benchmark. So when you are benchmarking, you are trying to look at the available data among those agencies that keeps those data to know what should be the price to be used for this particular TP transaction. I've also mentioned what a capital rich or low function company is. Capital rich or low function companies are companies that have huge capital with no risks that invest on other related entity. And the regulation is very clear. When there is no risk attached to the capital you are giving out, the compensation that comes with it should also be without risk elements. Then we've also explained what connected person is. Then basically every entity that is exposed to TP should do these basic returns. They're expected to do what we call the TP declaration returns and TP disclosure returns. In addition to this, they are also expected to maintain and only made available when FIRS so asks for it, what we call the TP documentation, or what we call the contemporaneous documentation. So they need to maintain that TP documentation policy. And I've explained that one before too. It is just a policy that talks about how many related or connected persons does an entity has, what are the transactions that that entity, that connected person carries out with its related entities, at what price or what methods, what pricing method do they use, and all of that. So that is what TP documentation policy or contemporaneous documentation talks about. So quickly, before we round it all up, we have a few slides at the end of this. What is how are you expected to file the the TP declaration returns or form? Section 13 talks about this, and it says that connected persons shall declare its relationship with connected persons, whether such persons are resident in Nigeria or elsewhere, in the form prescribed by the service, that is FRS, from time to time. I'm sorry I had to be a bit faster because I want to manage our time. So the returns shall be made not later than 18 months after the date of incorporation, or within 6 months from the end of the accounting year, whichever is earlier. You will observe that this position is not different from the position of the company income tax returns when a company is actually filing the returns for the very first time, right? So that then means that the deadline for filing returns, CIT returns, is also the same deadline for filing TP returns. So that then takes us back to why we put forward this particular training, for you to reassess your clients or your company to know whether there is TP risk. If there are embedded TP risks and you meet the TP returns threshold, you must make those returns to avoid penalty that FRS may so levy when one is default. Updated returns is also required upon occurrence of the following. When do you should make declaration returns, and you should also make updated declaration returns. But when would you be expected to making updated declaration returns? When there is a measure of the person's parents, that is the connected person's parents, with companies outside the group. When there is a merger, you should make the TP declaration returns. When there is an acquisition of up to 20% of a connected person's parents by persons not connected to the group. When there is a merger of persons with another company, and when there is acquisition of up to 20% of persons by persons not connected to the group. I'm so sorry I have to fast because the time is not really on our side. Also, when there is merger of acquisition of persons by another company outside the group, or where there is sales or acquisition of a subsidiary by a person, or when any other changes in this structure occur. The updated returns shall be made within 6 months of the end of the accounting year in which the event occurred, right? So please, I need to stress here, because we have made a promise that every attendees of this training will be eligible for certificates of attendance. This is not to attest to your proficiency, but to just attest to the fact that you've attended training of this sort. So for you also have a track of this, please, at the end of this training, everyone who is on this chat room is expected to send their email address, their full name and email address to my WhatsApp number. I'm sending it now. Please send your full name, your WhatsApp number, and your email address to my WhatsApp numbers for us to share the soft copy of the certificate of attendance to you, please. Why we are using this approach is that not everybody that actually register for the training is actually on attendance. So we can't go by the record we have. We need to be double sure that we are giving these certificates of attendance or participation to only those who are with us from the very beginning to the end of it. So at the completion of this training, send your full name in the order you want it to appear on that certificate, send your WhatsApp number and your email address so that we can share it with you. For emphasis, your name, your WhatsApp number, and your email address. Please don't forget, send it to my WhatsApp number. Thank you. So let's quickly wrap up. Where there is an appointment or retirement of a director of a connected person, a notification shall be made to the service in line with the subregulation 4 of this regulation, and as may otherwise be prescribed by a connected person. So these are instances where you make declarations. These are instances. Please mute all your mics. Please mute all your mics. Darlington, please mute your mic. You are distracting us, please. All right. So what then is the penalty for not making the declaration, the TP declaration? Connected person who fails to submit declarations or notifications, as the case may be, to the service shall pay an administrative penalty in the sum of 10 million naira, in addition to 10,000 naira for every day in which the failure continues, while the fine for not making updated disclosure is 25,000 naira. So you then see the relevance why you need to increase your knowledge on this so that you can advise your clients rightly. I'm sure no client will be happy that because of any negligence of any consultant, they have such enormous exposure. They could have used that 10 million or more for something much more worthwhile. So for those who have exposure or clients within this particular area, or if you are not sure that you have clients that are open to this, please reach out to us. We can have a joint arrangement whereby it's either we train you on this or we do an assessment of your clients in this particular area without having any interface with the client. Be rest assured, our firm has a policy that we strictly work with agreements with our clients. We don't have any don't not any fear of anybody poaching your clients. We don't do that in KCP. But we ensure that we equip you with necessary skills to ensure that you serve your clients better. It's better you have a collaborative arrangement than you losing the client entirely. So where any person fails to make disclosures, okay, now on disclosure now, disclosure returns shall be made and submitted to the service not later than 6 months after the end of an accounting year, or 18 months after the date of the incorporation. So it's done in the same way as I've mentioned under CIT and that of the declarations, right? So all these returns has the same deadline. If your year end is May, other than December, you will then have to still comply with the same period you will have filed your CIT. But for most entities, that have exposure to TP and their year end is December, the deadline for filing this return is still 30th of June of this month. So where any person fails to make disclosure of transactions which are subject to this regulation within the specific period of this regulation, an administrative penalty shall be charged, right? It is the same 10 million naira or 1% of the value of the control transaction that is not disclosed, whichever that is higher. So technically, if your client is exposed to TP declaration and TP disclosure and you don't file the two, it then means that there is a potential 20 million naira, at least 20 million naira fine. This will not go down with any client at all. So let's do the needful to ensuring that we guide against this occurrence. Then 10,000 naira comes after every day the failure continues, right? So please, I will want to now, I need to emphasize that this is not all you need to know as far as transfer pricing is concerned. But you will see that in the last 2 hours that we begin this discussion, so much has been said, right? And there is so much that is still to be learned as far as transfer pricing is concerned. I want to appreciate everyone who has stood behind to listening to us thus far. I believe one value or the other has been added. But before we call it a day, please, I want to give some minutes to addressing questions from each and every of the participants that have questions to ask. So please start putting forward your questions now. Put forward your question. Any question? Kayode, you asked a question before. Can you repeat the question again so that we can address it or confirm if the question has been answered? Okay, since it has not been answered, put forward the question. You may unmute your mic to ask or put it as on the chat room.
All right, thank you, sir. Good evening, everyone. So my question was, a manufacturing firm transferred a used machinery to its sister company, that's a fellow subsidiary. So if the cost of the machine, the MBV of the machine as at the date of the transfer was 25 million. So what price, what method should be used to determine the price?
Okay, so the question is, before you mute your mic, don't mute your mic yet. Okay. The question to you then is, because there is no one-way answer to this. The first question is that company is that company usually in a business of renting that kind of machinery?
No, it's let's assume is a part of machines they use in the ordinary course of the business. So, and they have an idle machine which can be utilized in the other subsidiaries. So we now have an arrangement where this machine is moved from that entity to another company, but within the same group.
Okay, the second question then is, these are the questions that you will ask yourself before you arrive at a reasonable and objective pricing for that. The next question is this: if assuming the entity that has the machine don't have it, and the other entity within the group needs that machine, can they have that machine being leased from an unrelated entity?
Yes, but it cannot be found probably in the country of residence of that entity. So it's an imported machine. So It's not a cost
Okay.
more. Yes.
Okay. Okay. So if it are not be readily available, right? Then the
Yes.
next thing is that it's either we then use cost plus method. Cost plus method
Okay.
is that what is the cost to particularly when you are not giving the machine to them indefinitely. So what is the cost of that machine, which may not necessarily be the cost, the book value. What is the cost of giving out that machine for the period of the usage, and what is the return, the minimum return that company will have expected on it? You understand? Then secondly,
No.
this is another thing we do in practice. For you to say, sometimes we might think that that information is not readily available. But when you check some of these database, McKinsey and the likes that FRS also uses, because when we are
Yes.
doing the benchmarking, by the time we want to do TP documentation for a client like this, we will have to do a benchmarking analysis. In the benchmarking analysis, what are we looking for? We are looking for companies of a similar nature that could have a similar machine, right?
Yeah.
That has
Yes.
been given out to the public. At what price do you think is from the database have they been offering it? Do you understand? Between
Yes.
the space where you are operating, you might think the information is not available, but trust me, it will be very available. But when
Okay.
it then happens that it is not available, you can then choose among all the 5 methods that has similar attributes to what you are doing. To me, it appears that something that is very close to it is like that cost plus
Yes.
margin.
Okay.
Cost plus method.
Okay. Okay.
You understand?
Yes,
But
sir.
if you still have any other question in that light, you can private chat me,
Okay.
right?
Okay.
Yeah.
All right. Thank you
And
very much.
it is also good for you to note, I don't know who the client is, whether it's your employer or your client, but just private chat me, we can have more discussion in that light.
Okay. Thank you very much.
Somebody else asked that, can we conclude that Nigeria is a tax haven base on the yardstick of your slide above? Nigeria is not a tax haven. You see all the aggressiveness of the tax authorities in Nigeria. So far from it, Nigeria is not a tax haven. What is the implication for not using arm's length when a group company transfer goods to it? Of course, they will be exposed to transfer pricing risk. And of course, some of these fines that we have mentioned, if they did not file the returns, they will also be exposed to those fines, right? So one is you not using the transfer pricing methods and filing the returns. But if you then want to file the returns, it means the content of the returns will then not be true. So there is also a fine for providing false information. Sure, you understand. So Kasali, I hope that answers your question. Any other question? Any other question? Okay, so in the absence of any question, I want to say a special thank you for trusting us to being of training service to you. This training is being anchored by KCP. KCP is Kunle Cole and Partners. It's an audit firm with expertise in audits, tax, account support service, tax services, and training services. Should you need any training service in your company or your firm, be free to reach out to us. We have personal training modules and organization training modules. will be willing to be of service to you. We are also open to you giving us referrals, whether on audit engagement, tax engagement, and the likes. And it is also important for me to stress that we currently have a WhatsApp group for all our existing and prospective participants, training participants. The relevance of this is that it's a very easy way of we disseminating information to intending members. I will also rub minds on technical issues. So should you have any technical concern, you can private chat us. The ones that we can give for free, we give. The ones that will be at a fee, we tell you it will be at a fee. But our fees are very, very moderate and considerate. Please don't forget, the easiest and the best way for us to reach out to you, particularly because of the certificate of participation, is to send in your WhatsApp number. Send in your WhatsApp number, your full name, and your email address to my WhatsApp number. We will only send those certificates to those whom we have this number. I've sent my number again, 090-244-00652. Thank you so much. Enjoy the rest of the weekend while we urge you to look out for our next episode of public training. Thank you. Good night.